Yeah, you can.
Okay, recording. Take one.
Hi everyone, we're FMC Technology. I'm Lizzie McCool, joined by
Mike Thomas. Chris Hemlock.
Daniel Sawyer.
And what we're going to do right now is take you through our current strategy and situation with FMC, as well as discuss our potential opportunities going forward and how we see that fitting into the total strategy of our company. So first, to just quickly go through our current situation. Right now, some of our strengths we see is that we stand as the market leader in the subsea segment. In 2012, we won 40% of the tree orders. We're carrying a low SG&A as a percent of sales. It's about a little over 10% right now in 2012. We've had a few recent acquisitions that really strengthen our market position. They're bringing us into new technologies and really getting ahead of the curve in that, which we'll talk about a few of them on the next page. And then also our reputation in the industry. We've won several awards from both Fortune magazine and Forbes magazine about being some of the most admired companies in the world right now. Weaknesses we see our company facing is that there's going to be some headwinds, especially in North America in the subsea and surface businesses, especially surface technology. That's expecting to decline worldwide, and that's about 25% of our revenue in 2012, especially in North America. Some vulnerabilities for our company: the nature of the oil and gas industry and customers. You know, as we've talked about before, it's really few customers in the industry as well as few competitors. So it's really on a project-by-project basis whether or not we win the awards. It's not really a solid, consistent customer base. It can fluctuate. Additionally, our exposure to just general commodity price fluctuations will definitely affect how projects are proposed to us going forward and whether or not they'll be attractive. Additionally, stalling of global economies. With the regulated industry, it's also going to be hard. You know, if we're trying to grow in emerging markets, there's a lot of different laws and regulations coming into play, as well as just, you know, economic crises, whether or not these projects will even be undertaken. And then finally, just similar with that, geopolitical risk as well as project delays, especially in the emerging markets, and these high-risk areas could affect our business going forward. And then finally, some opportunities we see. There's increasing demand for subsea in the coming years, is forecasted, which is currently 65% of our revenue. And as we said, you know, we're the market leader in that area, so we think that's a really good place for us that we can really grab onto going forward. Subsea pricing is expected to improve, which also supports our strategy, which we'll discuss on later pages. And we really think we're strategically positioned with the systems integration as well as service businesses for what we expect to be good revenue potentials in the future.
So I'm going to walk you through now kind of a little bit about what our company's done in the past year or so to build that growth platform that we think is going to be a competitive advantage for us in our future strategy. So on the left-hand side, that's basically our growth platforms as communicated by management. So the first there is subsea processing. This basically talks about our technology that we're developing in the subsea business, particularly outside North America. In 2012, we had a qualification of a new pump that is more efficient, it's better processing, it's faster, it's easier to fix, and we partnered with Sulzer Pumps to help develop that. We put a lot of R&D money into that, and we see that as a huge opportunity in the coming years. Also, we had strong growth in our multi-phase meters business, which is basically a measurement and control business that we have in our subsea division. So we saw strong margin growth there, and we saw strong revenue growth in the multi-phase meters, which has helped our subsea portfolio overall. Second, we have our subsea services growth platform. On the right-hand side, you can see a couple acquisitions. First of Schilling Robotics, which is basically a ROV offering. Those are remote mechanisms that can go and measure the flow levels. They can perform some repairs. So our acquisition with Schilling is going to help us be more strategically aligned to grow there. Also with CSI, it's just another control integration system that we acquired in 2012, and this is going to allow us again just to help us grow in the subsea services platform. And then lastly, we established a JV with Edison Showset Offshore, which is helps us expand our capabilities in our logistics. So what they really specialize in is getting all the equipment from land out to the subsea the subsea rigs, and they'll help us get there, and it's just going to help our supply chain. It's just going to be better logistically. Lastly, we see opportunity in shale, which basically refers to a large growth in natural gas in the fracking technology. So we're looking to use that and leverage that as a growth platform in the coming years. There's a decline in natural gas prices that have impacted us a lot in North America over the past, or in the coming years, and we're hoping to leverage this to help sort of mitigate that risk. So overall, we're building our subsea portfolio, and we're operationalizing these strong growth platforms that we've outlined, and you can already see that we've invested heavily to do that. This slide is just a kind of a high-level look at our pro forma over the next 3 years. So the top where it says management strategy, that's kind of our high-level strategy as articulated by the management team. And then the bottom where it says highlights and assumptions, that's kind of how it's reflected in our financial statements. So the first point there I touched on in the last slide is just really focusing on our 3 growth platforms: subsea processing, subsea services, and our shale opportunities. You can see high top line, 20% growth year over year. This is going to be driven by the largest deal that we've ever signed in company history. It's $1.5 billion. So that's helped add to our backlog in 2012, and that's going to translate to revenue growth over the next 3 years. The next point is just leveraging our industry expertise. So we're investing high in R&D, particularly in the subsea business. So we pride ourselves on our technology advancements and our competitive advantage in the technology, especially in subsea. So you can see that our R&D is increasing. It's steady at 2% of revenue, and we're going to continue to invest there to make sure that we have a strong platform for growth. Next, we want to make sure that we're maintaining our market leadership in technology through continued investment in people. And when I say continued investment in people, we mean focusing on our people, our employees, as well as the customers. So one of our greatest advantages is our long-term partnerships that we have with our suppliers and everybody up and down the value chain. So we're going to make sure to continue to focus on that to ensure that we're reinvesting in those relationships, as well as in our people, in training and education.
All right, so Lizzie touched a little bit on some of our key risks when she talked about vulnerabilities, but I'll go into those in a little bit more detail on this page, as well as some of our mitigating strategies for these risks. So some specific risks for our company, the declining natural gas prices, that's really having an effect on a lot of our customers. A lot of our equipment, a lot of the equipment is demanded by customers that are selling the oil, the natural gas that they produce at lower prices, so that's impacting their margins. So they are much more hesitant to invest in upgrades and other things that would benefit us. And highly cyclical demand and dependent on crude oil and natural gas, that's pretty self-evident. There's a lot of ebbs and flows in both the crude oil and natural gas markets. And then increases in price for raw materials. Commodity prices have swung up and down in the last couple of years. That has a direct impact on a lot of our variable costs. And then the services mix. Mike mentioned Schilling Robotics moving a lot more into the services side of subsea. And is that going to have the sort of margin potential that we're expecting or not? So a little bit of mitigating strategies for these specific risks. Continue to invest in surface shale technologies and fracking technologies. This is the way the world seems to be moving right now. So we want to make sure that we take advantage of that. We're very strong in subsea and not quite as strong in surface. And we think that the subsea is going to get there, specifically in natural gas. But it's mostly been onshore right now, so we want to make sure we get involved in that now, so we can lock in that revenue stream. And then ensuring continued investment in these technologies and focus on fulfillment and more operational basics to really make sure that we achieve what the customers want us to do. And then investing in acquisitions and JVs. You mentioned a couple recent acquisitions and JVs. Moving into specific markets using these strategies helps reduce the risk that we would have. And then some broad general types of risks. As a oil and gas equipment maker, we deal with customers all over the world, and especially in very high-risk areas. The Middle East, specifically, obviously high risk with a lot of the regulatory aspects that go into that. Europe, Total SA is our largest customer. They're a French company. So the struggles that Europe is going through right now have a very direct impact on us. And then, and also in Latin America, Venezuela, PDVSA is one of our biggest customers. The new presidential election that's happening there, how is that going to change the profile in Latin America? So that's a little bit about the risks, and Dan will go a little bit more detail on our evaluation.
Just really to kind of put the picture together on our strategic evaluation, we really tried to evaluate our industry environment, and what we saw is that the offshore growth is expected in the long term, so we feel really comfortable with this perspective. We also know that there's short-term growth coming from unconventional onshore, and these are the two kind of environments that are guiding our decision. So as Mike talked about, management has really prioritized 3 FMC strategies, which is to pursue growth in the subsea and leverage our subsea products in order to expand our subsea services. We've really done a lot of acquisitions and JVs in this regard in order to move forward with our services and have a positive effect on our margins. And then we really are going to try to leverage these industry trends as we move forward with our strategy. Some of the positives, as we mentioned before, that we have a strong position in the industry, 40% market share in the subsea trees, so we're considered market leaders. We're going to continue growing with the trends and trying to diversify our revenues through a positive margin mix through our service stream. And then we want to really keep leveraging the brand equity that we have. Some of the negatives, we're of course very exposed to the macroeconomic volatility that we're seeing. There's a lot of headwinds in North America, and so we're geographically vulnerable, but we have seen some of growth in our international regions as well, so we can kind of leverage that to offset. And then some of the a quick negative we want to highlight, as we're always trying to give customer value, we don't do dividend to shareholders, so how can we, throughout our strategy, look to always add value through our market capitalization and try to offset any negatives from the macroeconomic trends, such that we're always providing value to the customer, to the investor in one way or another. So with that,
we'll take questions if anybody has them. Yeah, Jake.
The pro forma, can you flip to that real quick?
Of course.
Looking at the top line, looks like a 20% CAGR
Yep.
for the next 3 years.
20.4.
20.4, thank you. Can you just talk a little about that? Like how quick is the market growing? Are you stealing from competitors? And is that based, is the growth based on like total global energy consumption increase?
No, basically it's based on our assumption that our investment in our subsea businesses are going to pay off. We're really diversifying geographically because North America is just tough right now, especially with the decreasing natural gas prices. We're being forced to look elsewhere. So the majority of that growth is driven by subsea. Now, subsea will also become a larger mix of our total revenue. So I think it was 65% of our total revenue in 2012. That's going up to about 70% by 2015. So it's highly dependent, and that is a potential risk that if that doesn't materialize like we think it will, and if we don't operationalize on the opportunities that we have, that could be a potential risk. But it is basically our assumption that our subsea business is going to continue to grow. We haven't looked at larger energy demand, so I mean that's maybe something to take a look at and see if our assumptions are in line.
And I think some of the macroeconomic trends support that. I think offshore rig count is at its highest level in recent memory. The move towards natural gas is eventually going to start moving more into subsea as the onshore natural gas extraction becomes more difficult. So I think if you look at the macroeconomics plus our strategy, that's where we get the strong growth.
in that opinion is pretty much in line with most analysts' opinion about how Subsea is really growing now, and it will in the next 3 to 5 years. Kelly?
In terms of the acquisitions that you're planning on doing, I have 2 questions on that. The first one is, do you guys see any risks in terms of integrating so many acquisitions at the same time? And then the second question is related to your SG&A line. I'm assuming that, given the fact that you're acquiring so many companies, it's probably going to inflate your base cost structure, at least in the short term. How are you guys going to handle that in terms of restructuring?
That's a great question. Just to clarify, we're looking to expand in acquisitions, but the majority of our acquisitions were done in 2012 to help. I can flip back to that page. So this is all action that's already been taken.
Yeah.
So we're basically, trying to expand that growth platform. But in terms of integrating that into our overall company, it is a challenge. Maybe that goes on the risk page because, it will increase SG&A costs. That being said, we think our SG&A costs as compared to our competitors is one of the lowest in the industry. So I think we're hovering around 10%. Most others are around 15%. So whether we can keep our SG&A at our same level as a percent of revenue is questionable, but I think we can definitely keep it lower than our competitors. But that's something we're gonna have to think about is how the company is gonna integrate those acquisitions into the current culture.
I think inorganic growth always comes with risks. So if you look at our recent acquisitions, they're not stretches. We're not going into something completely new. Moving a little bit more into services, more into the shales type of stuff, so doing some JVs. We're slowly moving into where we want to be. We're not taking a huge leap of faith, and we don't estimate that we'll be doing that. More of these gradual steps that hopefully we can recognize the synergies and keep the operational rigor around it.
Janelle?
Just want to understand the shale investment that you've done. Is it natural gas or is it away from natural gas?
It's towards natural gas.
Now, because what I was trying to understand is one of your biggest risks is that natural gas prices are falling, but you've done a huge investment and you want to continue to invest in natural gas.
Mhm.
So I just want to understand how is that going to impact your revenues and all, because you've shown a huge increase in growth by 2050. What do you think it will impact in 2030 or maybe globally?
I think that natural gas prices aren't going to stay at this level, and that's built into our pro forma. It's a risk that they will, but I think that with the infrastructure changes that are coming along, prices have been low long enough that people are starting to move more towards natural gas. Jeep with its diesel natural gas locomotive and all the things that are starting to happen. Natural gas prices will start to increase, and that'll help us in the long run.
And we're really getting into the service side of that. So our Pure Energy acquisition, they're a purely services company. So that kind of goes along with our greater strategy of diversifying our revenue streams and trying to get a more revenue constantly as opposed to big equipment orders, milestone payments. So this is going to help us level that out a little bit. Yeah, Katie.
I thought, Chris, you gave really good examples of, regionally, a lot of our big customer base is PDVSA, Venezuela. And the fact that, North America volume and demand is down, I think might be helpful, and I don't know if this is available, just have, a map to show, here's where we see the growth, here's where we see the decline, just so it can, focus us on, crap, NAO is really down, you guys are really focusing on Latin America, Asia, or whatever. And my other thought was, I think, so Subsea is your focus, but I think we talked about before, it could be cool to see, here's the profit growth rate percentage for our Subsea platforms versus your drilling platforms, just to say, hey, drilling is not where we see the growth, or it's more long term. We're going to focus just on these Subsea pieces. I think that's, I don't know, I think it would be a cool way to present it.
Yep. Curious for Gash.
I think Jake.
Oh, Jake Salomon.
One more question. Well, it's two-part. First is that kind of follow up to the revenue growth.
Mhm.
I also saw 4 points of margin expansion too.
Yeah.
Is that mostly from Subsea equipment? Are you getting price there, or is that Maybe like variable cost productivity?
It's basically from the increase in our services mix. So our services are much more profitable than our equipment businesses. So all of our acquisitions, I think except one, have some sort of services offering. So basically, it's that margin expansion from the acquisition of the services businesses.
But we also have seen price start to bounce back, and specifically in 2012. So we think that'll stay there as well, so that'll help.
Okay. And second part, the way I think about it, if you guys are selling equipment that extracts natural gas, if natural gas is cheaper, then it's going to be more use for that energy. Wouldn't that help your industry?
It will, but if the natural gas producers, I guess, aren't making the margin by selling it at such a low rate, they're not going to be investing in equipment, investing in upgrades, investing in services as much as they would at a higher price. It's the same with oil prices. When oil prices take a jump, then the Exxons and the other companies you'll see also take a jump.
Thanks.
Anybody else?
You go ahead first. You'll have a lot of things. Mine are not too many. You already wrote feedback?
You're on track.
I'm like, you already wrote the feedback before we presented?
Yeah, I already did. No, it's this one again. I want to get a better feel for what are your highly profitable profit pools and where's the growth happening. So then once you do that, then you can tell me, okay, here's what I'm going to do. Well, here are my profit pools. Here's what I'm going to do, and here's where I'm going to end up. And if I can get that, then I'm going to be pretty happy approving your proposal, right? But until I get that, I was looking at it and I get it that you have 3 growth platforms, but then I don't get a sense of which one's most important to you and which one's going faster than the other. So that's what I'd like to know.
I mean, my comment was on similar lines as Curtis is saying, but mine was more on you've said many times that your acquisitions are all on the service side to diversify your revenue sources between service and equipment. It would be really nice to see what's the revenue mix you currently have with these acquisitions, what's the expected change in mix, and what is your ideal state of the change in mix. Do you want to target 50% equipment, 50% service, or you want to become a 40% equipment, 60% service revenue company? And that can kind of help me gauge, are you going to do more acquisitions or are you going to grow the acquisitions that you already have?
So look for more specifics around the strategy as far as like where we want to be.
Yeah, so like the way I think about it is you have a strategy on service. That's one strategy. I want to grow service. Then you analyze what is the profit pool of that service industry, what acquisitions do you have, how can you grow it. The second strategy you have is how can I make my subsea more profitable, which may be your new products you want to introduce or new markets you want to grow to. So within subsea you have multiple profit pools, whether it is by region or whether it is by product, and where are you going to go to increase that. So if if those are the 2 strategies, that it may make sense to think about it that way, and then bring it together and say what is the total of both from our financials. And maybe more useful to even split this and say service and equipment.
Just show the differences.
Yeah, show the differences. You can have 2 bars, which says service, equipment, what's driving growth in each.
Can you go back to the strategy and action slide?
Sure.
Bailey had a good point on the acquisitions, because when I first saw this slide, I looked at it and I said, okay, acquisition of multi-phase meters and subsea processing, acquisition of Schilling Robotics and subsea services, acquisition of control systems, JV with Edison, and an acquisition of Pure Energy. And I thought, okay, their whole strategy is inorganic growth, right? To kind of develop more capabilities. It wasn't so much geographic expansion, it was capability expansion that they wanted, right? So then I said, okay, does this tie back to to what they had said earlier on what are their core competencies or competitive advantages. Do they have a competitive advantage with like M&A and acquisition integration? But I couldn't really see that. So, I mean, but that's your strategy. So you want to see, okay, how is it underpinned? And so you would hope to see that, okay, we have really strong capability in this particular area. Like GE Capital, for many, many years, it had an expansion strategy that was very heavily dependent on acquisitions. And so when you go back and you take a look at the value delivery system at GE Capital, this floor in the back here, you see that whole BD area. All those guys are just doing M&A. And so it fits in with the strategy, the value delivery and capabilities and the strategy. So if that's a story you want to tell, then just go back and fill in the blanks for anyone looking at this.
I got a question. That's a great point. I think that one thing on this slide is that these are all things that we've already done in 2012. So, I mean, would it help to maybe clarify and just say, this is what we did, and maybe we're looking, now that we've done all these acquisitions, we're going to grow based on that? Because I don't think the company is looking to do another 5 acquisitions in the next 5 years.
Or they're not. So they plan on making subsequent investments in organic growth.
Yes.
So that's the reason why I said that if you do the profit pools that this acquisition has helped you get into, like if I start with a blank paper and say, hey, I just had equipments in 2000, then I realize that I have a gap in the service profit pool. So I acquired, Schilling Robotics. That gave me one piece of the service. But then there are these other pieces of service. So you can think about a map of the value chain or a map of the profit pools and how these acquisitions have helped you fill your pieces of the puzzle and got you to where you think you need to be as a company. And now you're saying, okay, now that I am where I am, now I'm going to grow. And to grow, I might need to do a couple of things. I might need to integrate them. I might need to do better allocation of how I use them. I might need to sell my company differently to the client, saying, hey, I'm no longer an equipment company. I'm a turnkey provider for you, where I provide you the equipment, I service your equipment, I help you maintain your oil rig. I do all the 3. So, there might be a change in how the company is going to present itself now that you have all the offerings that you need to be a complete service provider for an oil station or an oil rig versus just the equipment provider. So that might be a good way to think about how the strategy of the company is evolving.
Yeah, it's sort of like you had a strategy here, and your current state had gaps in it. So the acquisitions help you fill those gaps,
Yeah.
right?
Yep.
And then when you look at the business now, you have to kind of assess it for, am I in nice profit pools, and how do I build the barriers to entry now? Or through maybe intellectual property, patents. I'll give you a list of things at lunch on what you can do to build those barriers.
Like maybe different types of long-term service contracts that you can lock in with your clients.
Yes, lock in your key customers with long-term service contracts, right?
Because now that you have the capabilities, you can do different kinds of contracts.
Right.
Things like that you could do.
That's great feedback. Yeah.
One thing that might be helpful on this slide is just include how big the companies are, like annual revenue,
Okay.
so we can get a feel for how big they are. And
I
then
mean, I had a similar feedback because when you presented, for example, Control Systems International, you just said, hey, we acquired just another controls company. You're totally undercutting what you want to talk about on the page when you do that. So just try to choose your words. If you don't want to talk about all of them, just bucket them and say, here are 3 service companies that we acquired. They help us on remote servicing, controls monitoring, and repair services. Something like that. You can just shorten them. You don't need to say the whole thing.
Okay.
Because the names of the company are there. People will see it. You just need to say, we acquired 3 companies in the service area. We acquired 2 companies on repair. something like that to make it more shorter for you.
And second point there, maybe include like the organic versus inorganic revenue growth on the pro forma. Because now that we're talking through this, it makes more sense if you're growing 20% because you're spending, looks like a lot on acquisition as of 2012, so makes sense.
Yeah, it's gonna be hard to get
It would
to
be
organic
hard to
growth, like the acquisition performance after it's been bought by the company, it's hard to get tracked down.
Yeah, but don't forget FX.
And effects.
But what you can do is you can say,
Yep, good.
maybe this is 2011 and 2000, say 13, it's a bigger circle, right? So maybe this is a revenue number, this is growth percent, profitability, but either this is a revenue or a net income number. And to be able to show that the circle is bigger and the incremental amount is maybe the acquisition piece.
I mean, on your last slide, the only point I had was, like the last thing you say is that we don't pay dividend to shareholders. I mean, it's really, I think that it's the worst thing you could say, unless you're concluding that, hey, we're going to change that strategy and we're going to start paying dividends from next year, or because this is a strategy. Whatever you think is the right recommendation for this company, it has to come through. And when I see that, I'm like, why are these guys saying they're okay with it?
It's a negative.
Correct, but why are you okay with it when you're proposing the strategy of the company? That the company is not paying shareholders. So what is the benefit for the shareholders to keep the company?
Reinvesting. Pitch is reinvesting.
Share our capital growth, our stock price from
I think you make a good
our shareholder return without dividends.
Yeah, so
Versus what it would be with.
so somewhere when you show such a big negative, you have to somewhere show why the company has decided to do that and what benefit the company is getting and how it's reinvesting. Or you should choose not to show it. Right?
Well, one way you can maybe position it is that you can say you're not giving a dividend right now. But if you stay with us and you're good with this investment philosophy, right? 3 years down the line, our stock share price is undervalued now, and this is what it's going to pop up to. So you can show market multiples to show that you're undervalued, and that if you get to a maybe market average or more or premium based on your strategy,